Hello, Warriors. How's everyone doing today? Want to welcome our viewers at investing.com. A couple of charts of interest I'm going to share this morning. Shahab, Sai, Reddy, nice to meet you. Welcome to Face. Isaac, yes, we always start at the top of the hour. That's why I have that little sticky note up there. Okay, so how low can they go? And that's a question a lot of people are asking in about the yield market. And when you look at the 10-year, way overshot even Elliott wave targets of 110 here. And the short end of the curve is not what I'm talking about here. I'm talking about the 30-year here. Okay. FX trader is gold, like Goldfinger. Goldfinger. He's the man with the golden touch. Well, get ready to take profits on that if what I'm going to talk about manifests. So here we are on the 30-year. I'm looking for one more drop for 3 drive to a bottom here. Now, I'm not saying this is going to be the top in bonds, but I do believe it's going to be a low in yields, at least for a while. So here's drive one, here's drive two. Of course, I'm not going to jump in front of it, in front of the NFP, and maybe we'll need a disappointing number in the jobs number tomorrow to get this final push. So I think within the next 3, 4 trading days, if we're down here, RSI stays above 30, I'll be probing it. So, how do you take advantage of for a bond rally? Not a bond rally, a bond correction. So I'm talking about a bond correction. Here's TLT. So the opposite ETF, if you're not a futures trader, where you could just short the 30-year. Here's something that's analogous. It's the other side of TLT. So TLT going up, TBT. So perhaps one more low in TBT, but I want you to look at some of these things long term. You can see they've fallen quite a bit. I could go out to the weekly, and I'm not talking about, a home run ball, and we may even try 1750 in the next few days, but a rally back to here and here, I think is viable. And here's the monthly real big look. So you could see that, this has really been quiet. And if you really want to look at a divergence, this has lasted since the beginning of the year 2015. So we've had 5 years of monthly divergence. And really, when you think about it, not that much lower than they were a few years ago, although we're making record lows and we're getting, people finally paying attention to how low interest rates have gotten. So if this scenario plays out, and you're not a bond trader, I think it will coincide with some type of low in the yen. And I've been waiting for this, been bearish, waiting for this red line at 78.6. Talked about it with Steve last week. It's going to come in around 106, 106.12. So if we get a bottom in yields, we could get put in a bottom in US dollar yen around this level down here. I'm wrong under the low the move when I'm probing it. That would be, your 104 level that has held quite a long time. I mean, going all the way back to the flash crash that we had at the end of 2018. So I asked myself if these two are correlated, right? And we've all seen what yields have done, correct? So here's the end weekly, and here's the 10-year. So the 10-year has really just melted. And this wasn't a surprise because we were calling for it here, the bounce. And then I was thinking 135. So the rubber bands can always stretch further than you think they can. So if that's the case, we should be close to a yen low, not close, but 80, 90 pips away. I'm looking at this 106 level. So we'll see what happens on an NFP day tomorrow. Otherwise, perhaps it waits until next week to turn. And the other part of the jigsaw puzzle is if we do get a low in US dollar yen, a low in yields, and gold continues up, perhaps gold makes a new high. Sure looks like it could. Very positive week. Here's your daily. It's trying, and at new highs, this may be the first RSI reading in gold under 70, but why be a hero? Why not just short something that has made lower highs like silver? Silver hasn't made a new high since September of 2019. We had this little stop hunt here during the last big move up in gold and the fear move on coronavirus. Okay, I'm sorry, still. And I'd look for shorts up around 1780, especially if gold's making new highs and silver is not taking out this high, but just giving us a retrace. So sells listening, so I'm not going to talk about my downside target, but I do, I do think there's a short.
I see silver going to 10.
I know you do.
I'm
You're
joking.
both
I
you're
know.
both fired. Okay.
I'm joking. I'm joking. I'm
Well,
joking.
actually, all right. So, I look at this Stell and, just, we could say it's basing, right? When you look at but what's so bullish about that?
I agree. Can go lower on this crisis. Definitely.
Yeah. So, what I want to know from you after talking about yields is what is the instrument? Because it is true that yields did not drop as fast in Europe because they don't have as much room to go. What's the instrument you're using to take advantage of rates troughing and beginning to rise in Europe?
Yeah, I've bought an ETF, which is an inverse 10-year German.
Oh, it's
Uh,
10-year.
yeah.
Do they have a longer duration on that?
I was looking for one because 30 years is negative as well, but I couldn't find one. So
Oh, okay.
good
All
question.
right. Okay. Anyway, those are my thoughts today. We have a great guest. He's on CNBC all the time. He's one of the whole team's favorite guests. And what a great day with what happened in the markets over the last week to have Mark Newton here to pick his brain. So stick around for that at the top of the hour. And I keep trying to talk the team into, charging for face. What do you guys think? Not you guys, the audience. I know what you think. Anyway, so I think that if you did well, like on calls that Steve Volge made, like that an interest rate cut would be a shorting opportunity in S&Ps, you paid for your subscription for about a decade on that day trade. So at least give it a shot for $1. I will refund it if you don't get you don't think you got $1 worth of value, because this team, and I've been around a while, Hi Sinatra, is the best team I've ever been a part of. Okay. I mean, there's so much talent. And you know what's even better than their talent? They care about you and they want you to succeed in this business. And you have a community to hang out with after face is over and go in there and ask questions of pros that do this for a living. It's not a hobby. So give it a shot. And also, I don't mention it enough, but we do have a sponsor at Forest Park. And if you're overseas, you could get reimbursed for your subscription just through your normal trading. And if you're here in the US, you could get a rebate check and take the family, well, go buy some sardines and stock up for Corona. I only have one comment on the coronavirus today. Where are the million people protests in Hong Kong? Have you noticed they've gone kind of quiet? All right, Blake, how are you, bro? Blake,
I am good. First of
I
all,
know
you
you're
want to talk
loving this
about
stuff.
yeah, I'm loving this volatility.
Yeah.
You want to talk about a really good call is Steve was in our chat room last night, and as the stock market was ripping, it was ripping towards
Yeah.
31.25. He was shorting at 31.25 at like literally the high,
Wow.
right there, just as the
Yeah.
market was closing.
Yeah.
And and it was a wonderful trade. So, you know, that's just some of the benefits that you get, you know, with Forex Analytics, is being in our chat room and being involved in our community. And that's part of, you know, the premium package if you are if you're a subscriber. But remember, as you're testing out Forex Analytics, it's only $1 for 10 days. You get, doesn't matter if you're on the light version or the premium version, you still get the premium version while you're testing. So make sure you join us in the chat room. Okay, so enough of the sales pitch. Let me move into what. Well, first of all, let me talk about some things that I did last night. And speaking of the chat room, everybody in the chat room knew I was long the pound Aussie overnight. So I was, you know, I was buying this yesterday as we were down here at the 94.20s, 94.30s.
Nice.
Very bullish the pound, just because the pound, if you guys did not see the cable, it was breaking this resistance right here yesterday out of this wedge. You can see the wedge right here is breaking this. And I'm like, you know, stocks have had a nice run. They're probably going to roll back over. I was in the same camp as Steve, but how I decided to express it in currency terms was being long the pound Aussie. So because it was short Aussie dollars, I know Aussie is getting close towards the 66.60 resistance. I knew the cable was breaking out. So the pound Aussie was my natural choice. And so I was long overnight, and I got out this morning about 195, a little early. Because we were at the 38% retracement. You can see it right here. We were just kind of probing this 195 level, and I said, oh, you know, that's a nice, you know, 60, 70 pip gain. I'm going to go ahead and take it off. Obviously, it's going higher. Now, Dale, you were talking about the bond market, and you were talking about the 3 drive on the bond market, right?
He said he's going to be back
Yeah.
in 5.
Oh, he is. Okay, so he was talking about this a 3 drive in the 10-year. Now, here's the thing. And thanks, Steve. And by the way, good call on the S&P, by the way.
Thank you, mate.
The bond market, if you guys don't know what it looks like, you know, I've been referencing this chart a lot here. You can see the weekly chart, big breakout. We're testing the underside of this trend line. We are breaking out. Okay. The thing about the bond market, you'll notice, and this is a weekly chart. You'll notice this is really big divergence, right? Let me just show you real big divergence here. Okay, but what I'm most concerned with, because you know the question is, well, if I'm a currency trader, what do I do with that? All right, and just so you guys know, yesterday or last night on the I was at my kid's soccer practice, and when he's practicing for an hour and a half, my kid plays club soccer, so I'm you know stuck at the fields for an hour and a half. If I take him, I just walk around in circles. Well, I like walk probably 3 miles, and looking at my quotes and everything else. So the dollar yen was failing, and it was sitting here at this 70-30 level, and it was kind of just 70-38 actually is where I hit the bid. But futures started to roll over a little bit. Futures got below 3,100, and I said, you know what, I'm gonna short some dollar yen, and so I shorted it overnight. And when I got up this morning, we were trading at 106.90. And the reason why I covered it, just so you guys know, and it wasn't regarding bonds, because I wasn't looking at the bond market till I, really got in front of my computer and started, taking a gander around what's going on. But what I was looking at is this 4-hour relative strength. It's very divergent, and we kind of probed these lows, and I'm like, I don't know if I really want to be short down here, because if you look at the S&P, the S&P is also probing with it. Now, the S&P, I thought yesterday we were going to do this. So just know that I had to rewrite my analysis, because I thought we were doing this. We were doing a triangle. But what I think we're doing here, and I may be mistaken, I might be proved wrong today, whoops, is that, dang it, stop doing that, is that we might have a pennant formation, which, just so you guys know, a pennant would look like this. And just so you guys know, the pennant takes us to about 2,600 on the S&P if we play out. So that's what I'm looking at with the S&P. I don't think we're going to break down today. The reason why I say I don't think we're going to break down today, because I think we need, and I mean, we could, give us a catalyst, like, government shutdown in the state of California today. That would push us over the edge. But I think realistically, and I'm trying to give you a realistic scenario, is we have a jobs report tomorrow. Tomorrow is the non-farm payroll report. Now, let's take a look at, I'm just going to look at Forex Factory because I can look ahead here just real quick. And you can, by the way, if you can do it on Forex Analytics too, but I'm the reason why I'm not using Forex Analytics data right here, because you can see that the jobs report's coming here as well, just because I can see. I'm going to pull up a couple charts really quick that are a little bit easier to view on Forex Factory. Let's see here. So we are looking for 175,000 jobs. You can see our jobs report our jobs have been very stable as of late. We haven't had any big variation. I don't expect the jobs report this month to be too far off of the mark. However, I do expect employment to start to roll over due to the coronavirus fears. I think that the market's going to pucker up here. So the jobs market, I'm saying. So the reason why I bring this up is because in the event that we get a good jobs number tomorrow, and I'm just going to focus on the dollar yen just because it's, I was looking at it earlier. So let's just for argument's sake, and let me just imagine we stay in this range for the next 24 hours. So we bounce from the 107 level, we bounce back to 107.20. We kind of just hang out here. I'm just using that as a general guideline. Now, like I said, the dollar yen could break down today, stocks could break lower, and this idea will be out the window. Not necessarily out the window, but this is something that we might be looking at a little bit differently. Man, bonds continue to get just raked over the coals here. By the way, bonds are still ripping. But let's imagine we get a good jobs number tomorrow. Decent. When I say good, let me say that a little differently. Let's just say that the jobs report is not horrible. Okay. And let's say the dollar reciprocates by rallying. I am going to sell dollar rallies tomorrow. My hope, and I think our hope as traders, the best case scenario is that we get a strong jobs report tomorrow that we can sell into. That is my hope. Now, I don't know if that's going to happen, and I may be wrong. I may be a month off the mark. Maybe last month was a bad month, and it starts getting bad from here. That could be the case. But what I'm hoping for, hope and what we get delivered is two totally different things, especially when you're dealing with economic data, because I'm not an economist. But if you look at, let me just pull up Bloomberg's survey right now. This is Bloomberg for those of you that don't have a Bloomberg system. Let's go to the jobs report tomorrow. We are looking to create 160,000 jobs. Okay, that's real-time Bloomberg, analyst surveys. So let's say we create 150,000 jobs, or maybe even 170,000 jobs. We can just hope that we get some decent data, because if we do, I am going to sell dollars tomorrow. Like I said, I may be wrong. We may just get, the data may just start getting bad and deteriorate from here, which is, very much could be the case. But anyway, that's kind of like my battle plan. I'm giving it to you guys, early. Now, tomorrow may be a little bit different because hell, we might be looking at the euro dollar and it's trading, the euro might be trading at, or the dollar yen might be trading at 105 by tomorrow, and the euro dollar is at 114, and we go, well, what do we do now? And then it's going to be a completely different plan of attack, right? So just giving you guys a little heads up of what I'm thinking at this point. By the way, the bond market continues to get destroyed here, just absolutely getting mauled. Yields are, I mean, the bond market, let's look at yields, and we may make a new low in yields here from yesterday. You can see here or 2 days ago, here's the bond market just completely getting destroyed. Yield sell off, stocks are going to stay weak. One of the guys in my office, said yesterday, and I wholeheartedly agreed, that's why I was selling dollar yen last night, is that with yields down here, it is really, really hard to buy dollar yen when yields are down this low. And so when the dollar yen popped yesterday, it was, for me, it was an opportunity just to sell into strength. And we might get that today too. I mean, I'm hoping. You look at equities here, and equities look, man, they look gross.
I think we're close to a turn, Blake, in yields. If you pull up your 30-year, looking for a third drive down to about 150, and you were showing the yen, there's some pretty good divergence, although I still think we could trade a 106 even handle, 580 to 620. And that I'm looking for some inflection points in this stuff, not for 10-year to go back to 3%, but why not 135, 145, which is
look at the stock market right now. The stock market is just absolutely getting destroyed right at this moment in time. Here comes the S&P. They're coming down pretty hard.
Mm-hmm. Yeah.
I mean, by the way, did you know HSBC, they closed part of their trading floor. They have a coronavirus confirmed. That you can see, here's the S&P trying to break down. That's going to really zap liquidity in the market. And, we have to think about that when we're trading, because when there's less liquidity, like let's imagine it's not just HSBC. Let's just imagine it's Credit Suisse, it's Goldman, whatever. We get some
Forex
of these
analytics.
Forex analytics. Hey, fortunately, we all work from home. We'll just from our home offices, we'll just hunker down.
I'm afraid I'm going to infect myself.
You might. You better wash your hands after you pick your butt. I'm just saying. That's
a good coronavirus tip. All right, I promise.
All right, good. I'm glad.
Dad, such a dad.
I know I am. But the fact of the matter is that we are in a situation where liquidity could start getting really poor, and that's good as a trader. As a trader, we want to see liquidity get a little bit less algorithms, less liquidity gives us more volatility. So, but because of, if we get more volatility, that's going to yield, obviously some wow, yields are just getting crushed. I'm surprised dollar yen's actually holding up as well as it is right now.
See?
Yeah, no,
the dollar yen, 80 handles. 80
what I'm actually looking for is 106, because that's the big trend line. 78% retracement, 161% extension of this move.
We could be there tomorrow. Yeah,
possibly. I mean, stocks continue to weaken here. So I think that's entirely possible. So
yields already 10% higher on the day. 10% lower. 10-year yields 10% lower on the day.
Yeah, it's some pretty big moves, guys. So anyway, just a few things that I wanted to bring up this morning. Obviously, there's a lot more going on. I'm really bummed out that I actually had an order to sell Aussie dollars at 60, because this is the 38% retracement. that we are in a severe downtrend. I just, wanted to bounce and, to sell into strength. And unfortunately, it's not playing my game right now. So, so guys, I'm going to pass it over to you. Make sure that you guys try out Forex Analytics. Visit our webinar sponsor, Forest Park FX, when you get an opportunity. They will help you find the brokerage firm that's best suited for your needs. I'm going to pass it over to you and Stelios and Steve. That would be you, Dale. So
Okay.
hope you guys have a good trading session. Good luck today.
Thank you, Blake.
Thanks, guys.
Thanks, Blake.
And have a great interview with Mark.
Thanks, Blake. He's a great guest.
Yeah, I'm
Yeah,
looking forward to that.
It's a good
Really.
occasion that we have Mark. Yes.
Yeah, great guy. So
Are you gonna do you want to take over the interview again today, Steve?
Stop exaggerating.
I could go take a nap or something, Anyway, go ahead, guys.
Trust me, I need that. I need that nap more than you. With this market volatility and my son
nice call
being,
last night, man. You've been all over it.
You know very well that I had that order in place since some time ago. So I'm just executing my plan.
Yep, that's good. Okay, so we've been talking about this for days and days. People are doubting it. I maintain that this virus thing is obviously far from over.
Oh yeah.
If anything, it's picking up pace. I've read that, obviously I'm not there, so I don't know, but I've read that the cases in China and I think South Korea as well are dropping. The rate is dropping, but they're rising everywhere else. So
they've killed anybody that they couldn't lock down.
Yeah,
I'm kidding. I'm half kidding, actually.
Did you see Trump's was it an interview or something? The WHO yesterday they said that the mortality rate is actually around 3%. For this, based on the cases that we've had so far. And Trump on some news show said, "Oh, I think it's a false number. I think the real number is below 1%." I mean, how can you say that? But anyway, it's
he is willing to say anything. Facts don't matter, although he would have said the same thing regardless, right? No doubt about it. I mean, he has no problem trying to fool everybody.
I think he's trying to calm people down, probably. I mean, I'm guessing that's his...
Of course, but it's extremely worrying. I've read so many different reports. There is so little testing happening in the US.
Yeah.
So few cases that they confirm and so many cases that they don't. To be honest, the official fatality rate is something like 3.4%. But in this case, for all the wrong reasons, I do have to agree with Trump. In what sense? I bet there are a lot of people out there that have been undiagnosed.
Yeah.
And unless they die,
they'll never know.
They will never, and you will never know that they actually had the coronavirus. So if you take into account, I bet, a big chunk of people that just get it and it passes by like, a regular flu. I do believe that the fatality rate is lower than 3.4%.
All the freeways are still packed, guys. People are still going about their business, except for, stocking up on cleaning Costco out of toilet paper and baby wipes. But everyone's still out there. I'll have to admit, I was gonna run out and get something to eat, and actually I kind of have a second thought, like what you just bring up, Steve, like someone serving my food or preparing my food or handing off my food could be infected and not even know it. That's the worrying part, is are we going to have a demand shock? Because right now, I mean, you still have traffic jams. The I-5's a parking lot. So
Indeed.
Nothing's changed. We'll know by the freeway indicator.
The biggest percentage of the population shouldn't really worry about the coronavirus, but the issue is that we all have relatives or people we care about that belong to the sensitive. Yeah, exactly. By the way, as you see, I've pulled up data here. We just got U.S. initial jobless claims exactly as expected, 216 versus 215. US labor costs revised quite significantly lower. US productivity revised quite significantly lower. That's definitely not good. Continued jobless claims as expected.
Yeah.
I doubt that any of that is going to move the market, Stelio.
No, not at all. I don't think. And
Yeah.
to be fair, tomorrow's number, I don't think it's going to do much either. Even if
Me
it's
too. Me too. And most importantly, because during the past 1 month, a lot of things have changed, and currently a backward-looking number is really of no significance. I think that the numbers, I mean, the data will start depicting more clearly the effect starting, in like 15 days from now or so, because all those numbers are always backwards looking.
Yeah. What else did we have? We had oil. So OPEC have
Yeah, I saw OPEC's.
cut, 1.5 million barrels.
Yeah.
Although they don't have the agreement of Russia yet, but it's broadly expected that the Russians are going to go along with it. So that brought a bid to oil yesterday, and they have to do something, because we've seen WTI drop $15 from the top within a month. It's big, it's a big drop, and it's going to create a shock. But it makes sense, when demand drops like that.
Of course,
it's not surprising.
And that might balance somewhat crude's price, because if things are headed where I think they're headed, having to do with risk assets, without any support from OPEC, I think that crude could really get decimated. Not that it's unlikely that it can happen, despite having seen the cuts, but without them, without cutting supply, I think we could have seen a big shock lower in crude, which of course would have been great for the consumer, but whatever.
Oil is particular because it has some built-in stabilizers. When the oil price drops towards $40, then shale producers become less profitable. Remember, they're very leveraged, and
exactly,
they will stop production. So I think, I've said this for months and months. $40. I think obviously we can go below for a while, but $40 is probably a kind of a bottom for oil prices.
Temporarily
again,
we can even head down towards 20. I mean, we went
go
to 25 a few
yeah,
years ago. But that isn't sustainable. It isn't sustainable.
I agree.
Simply due to extraction costs, etc. And there will always be balancing supply also, to keep it supported. I mean, a lot of the big producing countries, will always do what is needed to keep prices at a decent level, and that also plays a role. And crude, on the other hand, is one of the, let's call it like automated stabilizers of any crisis, because things go south, crude prices drop, and that somewhat helps support the economy by making things cheaper. Unfortunately, we have central banks trying to undo what naturally an economy is supposed to be doing during periods of crisis, which is a good thing. I mean, a lot of people will tell you, I mean, all the propaganda from central banks will tell you that deflation is a really bad thing that we should try to avoid, but deflation is not a bad thing. Deflation is a natural good thing to happen during a recession. It actually makes the hit of a recession easier to the consumer by letting prices depreciate.
The danger, what people fear is deflationary spiral. But with the quantity of money and debt increasing every year, I think we're way past that point.
Plus, I've said it before, Stelio, I think that even what everybody teaches in Economics 101, the deflationary spiral, the whole logic behind it is, and then I'm going to jump on the charts, of course. The whole concept behind it is that if you let prices depreciate, then economic activity is going to slow down because nobody's going to want to be investing if they think that the value of money is going to increase on its own without you doing anything. But I think that this whole premise is flawed anyhow, because if you want to look at it from the side of the consumer, have you ever, I mean, computer prices keep dropping. Have you ever postponed buying a computer because you might buy the same computer next year, like, you know, $100 lower?
No.
No. Same thing with the television. No. Now, if we go to businesses, let's assume you have a 1% deflation. Okay. Do you know any businessman that wants to go into business to actually make 1% of a profit? No. So, you know, the businessman that really wants to invest and make a profit is not going to think like, oh, why should I go into doing a business? If I keep my money, they're going to be worth 1% more next year. Nobody wants to go into, you know, the whole fuss of doing business to make 1%. You want to do that to make 5%, 10%, 15%, 20%, 50%. Depends on, you know, on the sector you want to go in and the risk involved. So I think the whole premise that deflation is counterproductive and hinders the economy is a big propaganda even taught in universities. A huge example of that, and I've said it before, is that half of the period during like 19th century and the beginning of 20th century, the US had at least as many years of deflation as it has years of inflation, and that didn't stop the US from becoming, you know, an economic force on the planet, and, you know, leading in industrial revolution and everything else. So we even have historical data that show that deflation is in no means something negative for any economy. If anything, it is actually positive. And, you know, deflation is a natural development of any economy that is progressing in research and production, because we know that, you know, by mass producing things, you make them cheaper. And for some reason, we're trying to fight that like it's, you know, something bad and natural and damaging, which it isn't. Anyhow, back to the chart. So we have quite a few developments here. Now, I'm going to very briefly start with the S&P, saying that, you know, that was my plan all along here. You know, with a big question mark if this last part of the plan is going to work out. As I said when I drew that, that is the most bullish of the scenarios I have in mind, because I do think that there is a very high probability that, you know, we're going to just keep going lower. But, you know, even the most bullish case scenario, before we can consider any you know, higher highs, I think we are going to be seeing lower prices, and sharply lower prices. At the very least, I would be looking towards you know, 2600, 2670, and, you know, depends on where we fail from here. Now, 3125 was a very important confluence of resistances. That's why I shorted a little bit more S&P yesterday there. Blake showed in the lower time frame that this looks like a pennant, and I agree 100%. That's why I'm looking lower from here. And of course, whatever happens to the S&P is going to happen to the Nasdaq, is going to happen to the Dow Jones, is going to happen to the Russell. The Russell, by the way, was the only index, and I kept repeating that never confirmed, you know, the higher highs from the rest of the indices. Now, the VIX remains at, you know, based on the last 10 years, at very elevated levels. I remind you that the VIX is an index that shows volatility, irrespective of which way. The reason a high VIX is a negative signal is that it's extremely infrequent to have high volatility, as we've seen these days, including the up days, and not being in a turmoiled market. And usually a turmoiled market means a market that has more downside. So personally, I don't worry at all about like the big up days like the one we had yesterday. I consider such a behavior a very natural behavior of any bear market rally. Of course, we're not sure yet that we're in a bear market, but as I said, even if this is a correction, it is a correction that has, in my opinion, still at least one big wave lower to run. So, I consider this rebound a great shorting opportunity, and I've made that very, very clear. Now, having said that, the implications are very clear about everything else, and I want to start by the dollar index. We saw the day before yesterday how it responded from this ascending channel trend line support, but we're testing it once again. Keep in mind that if we break below here, and especially if we break below 96.36 to produce a lower low, I think that the dollar index has a big chance of failing miserably up here. Euro USD, which is almost invertly correlated, almost perfectly invertly correlated, at the same time is attempting to break out from this descending channel that dates back to 2018. So this looks quite promising as well if we do manage to actually break through that. So dollar, I think, is in danger of failing here. I mean, hasn't confirmed it yet, but we're getting quite close to such an event. So I would be very, very careful. Gold.
Really, the tell, Steve, the tell on the dollar was that first rebound in S&Ps, and the dollar did not even catch a bid. Remember, we talked about that the other
absolutely.
day?
And even yesterday, it ended up being just an inside day. I mean, nothing to write home about, just a simple consolidation.
Really heavy.
Now, gold at the same time, what do you expect gold to do when all central banks are, rushing to cut rates, increase asset purchases, and figure out what else they want to do? Of course, gold remains very well bid, and I do expect, that the path of least resistance remains higher, and we can see a higher high towards 1733, the 78.6% fib of the all-time high. I remind you anyhow that gold has since some time ago produced all-time highs almost against all currencies, right? I mean, US dollar is one of the few exceptions. So, not a really big surprise expecting to see all-time highs in gold versus the dollar when it has already produced all-time highs against the vast majority of the currencies. So, I really don't know why people are so eager to call the top in gold. Of course, gold is going to have pullbacks. There's no question about it. But do I see any real catalyst that would turn gold lower decisively? The only argument somebody can make is that gold can start getting worried that a recession is going to be deflationary, and a deflationary recession is going to increase real yields. Personally, I don't consider that a right assessment. I think that central banks are going to do the utmost to keep real yields suppressed, even push them lower if possible. And keep in mind, I'm talking about real yields, right, which is nominal yields minus inflation. And if I think they're actually going to manage to do that about real yields. Now, about nominal yields, it's a different situation, because I think that at some point nominal yields can actually explode higher, but the only reason they're going to explode higher is because inflation can explode even higher than that, and nominal yields are going to try to do some catching up. Now, having to do with the rest of the metals, as Dale mentioned, and we've said it multiple times, silver is clearly underperforming gold. So, if you want to be in one of the metals, being long, I mean, gold is the place you want to be. Platinum remains more or less under pressure. We're seeing a consolidation here at important support area, but, doesn't look that good to me. I mean, it looks like it wants to continue lower from here. Palladium remains under pressure, and it should continue to do so as long as risk is off. I'm still short palladium, and I find no reason why not to continue being so. I mean, I'm deep in the money, and I think, this can actually be, a very good long-term trade. I mean, at least medium-term trade. So I'm not looking into bailing out from this one. And having said that, usually you will remind me other things I want to talk about. Let me go through some of the questions. Greg is short gold in Twitter those days. Elliott wave analysis. I don't know if that's the case. I mean, I respect Greg very much. He's an amazing trader. There's no question about it. That doesn't mean that we have to agree every single time, right? Now, sorry, but I disagree with you. You're probably confusing Greg with somebody else, because let me show you. I just opened Greg's analysis on Forex Analytics. And as you see, first of all, it has a green traffic light, which means that he's bullish. As simple as that. And here is his 4-hour count. He's looking for a higher high. There you go. He's looking for a higher high. Okay, so Greg is looking higher. So I don't know why you think he's, there you go. He's looking higher, and perhaps he's looking for a failure after a new high. So at least in the short to medium term, I see that Greg is bullish. So probably you have misinterpreted something that he has said. Okay, let me go back to the question box. So let's see. The S&P pennant measures bear flag USD yen. Yep, agree with you. What about crude? Now, crude, as we said, here it is. Crude, as we said, is currently being supported by cuts of production. This was a nice reversal day. So far, I see a little bit of a consolidation. So if I were to guess what crude could do from here, my assumption would be something like this. So in the short term, I wouldn't be trying to short crude here. Okay, let me make it very clear. Now, does this mean that I'm bullish crude? No, I'm not. But I think we might see, a little bit of a, bigger recovery before crude can actually continue lower. So I would definitely not be short here in the short term. Okay, as simple as that. Trump only cares about winning an election, our friend David says. Unfortunately, and as I've said, I don't like Trump, but I don't think you described anybody that isn't a politician. If politicians cared for more than that, global economies would be at a much better shape. And as I've said many times in the past, one of the biggest problems that have led to the global economy being in such a mess is the political cycle. Each politician comes to power, and what they care about is, hiding the problems, under the rug, and making it through another 4 years, kicking the can down the road. But this is not a method to solve problems. This is a method to postpone problems by making them bigger and making the problems unsolvable when they explode in the future. So unfortunately, I don't think that Trump is the exception in that, I have to say. Regardless, you have 1 to 2,000 fatalities and they're going to be diagnosed as CV for the cause of death, even if they're older. This sounds bites of Trump saying not many young people are dying and there is nothing to worry about, are going to come back and haunt him. I agree with that. I think that soon enough, statistics are going to be showing that, by hiding the problem, temporarily, you don't help anybody. Russia announced last night that they're not on board with cuts. Okay, let's see what happens with that. Hey guys, could you evaluate Nifty? Yeah, sure, we can have a look at Nifty. I mean, on occasion we have a look at Nifty, but we haven't done so in some time. And here is the Nifty. So as you see, I was expecting a rejection from up there when we had this ascending wedge. And we're moving lower. Now, so far we haven't invalidated the uptrend. You can see that we still have a sequence of higher lows. So, do I think that this index can also break down? Yeah, I do think so. But as long as we are above 10,600, I think that we're still technically in an uptrend, right? It's first dip. Come on now, go in a real world example of Japan and discuss deflation from there. Okay, what do you want to discuss about Japan and deflation there? The problem of Japan is actually not deflation. But this is a big economic discussion that most will be bored of having. The problem of Japan is not deflation, and mostly deflationary pressures in Japan are coming from the fact that Japanese demographics are awful. I mean, Japan probably has the biggest demographic problem worldwide, if I'm not mistaken. So, yeah, Joseph answered to that, actually. I just see his answer. Japan is a unique case. It's a demographic train wreck. Yes, it's exactly what I just said. It is a demographic train wreck. So it is what it is. And, no matter what the central bank does, they cannot escape deflation with the current demographics they have. Now, question. Again, why do you assume that deflation is a negative thing in Japan? I mean, why do you assume that ceteris paribus, as they say in Latin, which means keeping all the other factors equal, if there was a magic button that could make Japan inflationary by changing nothing else in the economy, nothing, not demographics, nothing else in the economy. Really, what makes you think that by turning Japan into an inflationary economy, things would be better for the economy and for the people that are living there? I mean, if you want to make an argument of why, I'm eager to hear about it. Steve, where would one buy SPX for a good risk reward if you're bullish, thinking we're going to make new highs? No. I'm not bullish and I'm thinking that we're going to make new highs, but technically speaking, I can't prove yet that we found a high, right? So if we assume that we take it as granted that this is a corrective move lower, I can tell you as a fact that I wouldn't be looking to buy anywhere higher than 26.85. So I wouldn't be even considering buying anything above that. That's what I think, mate. But if you're talking like long-term value, I think long-term value for the S&P is 1800, something like that. So in essence, more or less, half of where it was trading, roughly half of where it was trading, or a little bit higher at the highs. That's where I think there is some real value in the S&P. Someone should tell or raise an issue in Indian market difficulties that are probably some kind of a spelling mistake. I don't understand that word nowadays. I'm not going to lie to you, not very familiar with Indian market intrinsics, so I can only read the chart for you. What about silver? I'm looking for selling opportunity. As I've said before, I wouldn't be selling metals. I can tell you that much. But if you want to be selling one of the precious metals, yeah, I do agree that silver is the one you should be looking for. Now, 1740, 1745 is a resistance area. So we actually tested that area the day before yesterday and today so far. So theoretically speaking, you can even sell it here if you really think it's going lower from here. Next area of resistance would be 1850. So, these are the levels I would be looking to sell if I was looking to sell. And, I want to make it very clear, I'm not looking to sell. Aussie yen at 11-year lows, no surprise there. Speaking of which, here is Aussie yen on the 4-hour chart, because I was looking at it earlier. So 2 possible interpretations for this move. Triangle is one of them. Pennant is the other one. But in both cases, there is no way to interpret this as anything else than a corrective rebound. So bottom line, I am looking for lower lows, both in Aussie yen and Kiwi yen. Look at this textbook formation in Kiwi yen. Big move lower, symmetrical triangle, we're currently testing support. Guess what are the chances for the next move from here? Lower. Question about the Aussie against the dollar. So here it is. There it is. Aussie USD. So as I was saying down here, when we were testing the 161.8% fib extension, that there is no real value in being short anymore because there was no risk reward. Now we've seen a rebound. We've approached the previous support area at 66.70, and I do think that now being short would make sense again against 66.70. Okay. So I do think that there is now risk reward if you're looking to be short again. Do I think this can work? Yeah, absolutely. I think that with risk coming under pressure, the Aussie USD is very likely to come under pressure again. Would I be trading it? Answer, no, I wouldn't be trading it. Question, why wouldn't I be trading the Aussie USD lower? Answer, because I think there are better opportunities out there at the moment. So you want to be bearish, it makes 100% sense. Personally, I'm taking other trades that in my opinion are more sensitive to risk off, which I expect to see. So
what a great interview.
Yeah, you see.
Oh, yeah, and it's Steve interviewing himself.
Yeah.
What do you guys think, huh? Pretty good. All right, man, go ahead. Question, why do I talk to myself? Answer, I don't know.
I hear voices, is that normal?
Yeah.
CDC hiring affects jobless claims down, says Scott. Grega, gold fifth wave reversal from fib zone with potential monthly reversal. Break of Feb low is needed to make candle top valid. Volume in this massive down. Yeah, but he has obviously changed his mind, because I can assure you about one thing, and Forex Analytics members do know that, mate. Greg updates his analysis every single day on Forex Analytics. So the analysis I showed you is not obsolete. The tweet you're reading is obsolete. And this takes us back to what Dale has said multiple times. We know we're very cognizant that Face Webinar offers a lot of value for free. But if you think that you can, get everything by being here 1 hour per day on Face, you are mistaken. Because we are traders and we have every reason to change our minds. Many trades are not easy to execute through patterns in play because they're very rigid, and we do that through the chat room, for example. And you don't have our analysis by just being here on the webinar. So as I said, the analysis I showed you is, a few hours old. So Greg is looking for a higher high in gold. As simple as that.
Mark is here.
Perfect. I'm looking forward to seeing what Mark thinks about this move lower, and if he thinks that central banks can actually contain the situation and the spillover effects from coronavirus. I think he's one of the best guys that go out on CNBC, so I'm really happy we have him.
Welcome back, Mark.
Thank you very much, Dale. Can you guys hear me?
Yeah, loud and clear.
Yeah, Steve just gave you, a great intro, and you can share your screen once Steve stops. And we
I
can see your
stopped.
there you go. So you
Okay,
look for
let's
that
see.
share button, Mark. The green box. Got it. Okay, Mark. So what a great time to have you here.
Yeah, thanks very much. Can you guys hear me okay? So
Yeah,
welcome to a new era of volatility. Volatility is certainly back.
I wanted to ask you,
Finally.
previous two interviews, your cycles were pointing towards trouble in the spring. So we didn't quite make it to spring. We're only a few weeks away from the equinox. We're attempting a rally here. Could it be that the cycles you were looking at that we put in a secondary top? And do you think that this bounce has run its course, or there's more left in it in S&Ps?
Yeah, I mean, there are a number of different cycles. One of them was related to a Saros cycle that actually hit the day before 9/11, which was triggered back on the 19th of February. And so for those that have an interest, I'm happy to speak about that at a later time. I won't take up too much of your time discussing that, but it is pretty
You also have some stuff coming up in the spring. Wasn't that what you were talking
about?
Yeah,
I think as we enter April, it's going to be a little bit more interesting. So I think this is what we call the shot across the bow. We've had our initial sell off. I'm not, all that bearish right now. I think that, for the time being, we put in at least a decent trading low that I think probably can carry a little bit higher. My targets are up, around 3180 to 90 or so on the S&P. So
61.8 back there, Mark.
Yeah, there's a lot of things right up there that are important. So for me, we saw a pretty rapid reversal of some of the things that were a concern last month. At that time, we had pretty rampant weekly overbought conditions. Now we have, at least daily oversold. We had a lot of optimism back then. Now we have pessimism. And a lot of the reasons why the market declined were due to just a lot of the overconcentration of many stocks. Within the S&P, we have the $5 trillion stocks that are, now 19%. So there's a lot of overconcentration, and you look at what was really carrying the market higher.
Right.
And
do you believe, like me, Mark, that this was going to happen anyway, and that the coronavirus is just an excuse and lit the fuse, but that we had
that's right. It's
some
market catalyst.
structure.
I mean, the market certainly isn't selling off, specifically because of that. I think a lot of the stuff started to turn down in the middle part of February, and should be actually negative for the year as a whole, if I'm right. After a number of years of being bullish, I actually went negative for the year in January and said this was going to be a down year. And historically, when you look back, there's only been 11 times when both January and February have been negative, and the year has been negative every time. So I'm not convinced yet that we've seen sufficient damage to say it's going to be straight down. I think it very much could be a choppy year, but if my thinking is right, I think we do get the weakness from April into July, August, and then rallying into year end should make us want to sell into that, and that next year would really be a very negative year. So this year could be flat to maybe slightly down, but I do see what happened likely has turned a lot of the momentum down pretty substantially. And I'm trying to be very tactical and not swing for the fences. My trading time frame is very short term these days. So
so that's another way to manage risk, isn't it? To not only reduce leverage but reduce TFs, time frames, and
you have to not only be extremely diversified, but keep size very small and have a lot shorter time frame, and just keep cash on the sidelines for opportunities. I think there'll be opportunities for longs and shorts this year. So, today's movement, in the last couple of days, just to put things into perspective, I mean, the volume yesterday was pretty much the lowest we've seen in over a week. Technology really didn't participate all that well. today's weakness thus far is only given back about 50% of the prior move. So it's not all that damaging technically yet. If S&P were to get down under 29.76, yesterday's lows, it seems like we're down over 2% and we're not even near yesterday's lows, which is amazing. It tells us how volatile things have been. If that happens, then of course I would say, okay, we're likely going to test, if not take out the lows.
You have to be very nimble, nowadays.
You certainly do.
Mark, last time we were together, I had a negative view and bias on the banking shares because of what I saw was going to happen to yields, and you and I agreed that we were going to see sharply lower yields, that yields had not troughed yet, and the XLF never made new highs while the S&P were marching to new highs. So I'm thinking, I don't know what your look is, but I'm looking for about 150 in the 30-year yield. And I think that we're very close to putting in at least a trough in rates, not the bond top, but enough for a bond rally. And perhaps that could get the banking shares back into the game for at least a good bear market rally. So what are we looking at?
I don't disagree. So let's start with XLF first. So XLF was right near the highs from 2007. We never really did get above there. It was a pretty prominent peak. Financials were the third best performing sector last year. Everybody's, and now we're seeing mean reversion, but that started largely with what we saw with, the banks. I mean, so the banks, certainly a different animal. And this is all about know what you own. XLF, of course, with Wells Fargo, Berkshire, JP Morgan representing a large amount, but the banking shares certainly have not been doing all that well for some time.
They went all the way back.
And we had a very rapid pullback. And so, we obviously, as rates started to turn down, banks literally right when rates peaked started to also accelerate. And now we're seeing a little bit of exhaustion here in the KBE, meaning that I think that we're close to a chance when these can bottom and at least start to rally off that low. Okay. I would agree with regards to, and I've heard a lot of people say that, which concerns me, but everybody's trying to put in a low in yields. I don't disagree, I guess, from a short-term time frame. I think that is possible, but we certainly have done quite a bit of damage with regards to, on a weekly basis and a monthly basis, getting down under lows from both 16 and 2012. So,
I'm thinking more of the long end, Mark, and a possibility of, even with yields falling, it looks like we're really not inverting during this decline. Because bonds have been a little bit more, the 30 years been a little bit more reluctant, but I see a 3 drive pattern developing there. Part of the damage was we finally got a pretty good break in the Dixie along with risk. Does this dollar break look like a real turn to you? And I think a takeaway this week was when risk was back on, this week, the dollar couldn't find a bid. Where are you at on the dollar here?
Yeah, I think the damage has been pretty substantial in recent days. We'll see how it would need to obviously get down quite a bit further to say that a larger top is in for me. But a lot of the cycles do point down for this year and over the next couple of years. So, monthly chart. Let's see. We can look at the DXY if you like. That is largely against the euro. This is a little bit more balanced. Near term, I think the dollar peaks out in about bottoms on a short-term basis, probably in the next week. Euro's up against pretty good levels. There's signs now of exhaustion in the DXY. So, I don't know. I certainly wouldn't, press euro longs or anything. I think the move is, we've seen the first move down, and we'll see what type of balance we have on that. I think we're closer to a trading low in this. If we take out January lows, you can make a larger case that the dollar is going to start to really implode, and that we're going to see euro and sterling.
So perhaps some type of fib retrace back to 98 to 99 might be a good area.
Yeah, that's right.
There.
So I see probably, I don't even know that we're going to get too much lower than 96.5. I think in the next 3 to 5 days, we should try to bottom out in that. The BBDXY is not quite there on the exhaustion. So euro is there now. I think that the other currencies might see a little bit more even here, you look at Bollinger's, and we shouldn't go down too much more in the dollar in the short run. So
Right.
from a trading perspective, I would play for a bounce, but yeah, from an intermediate term perspective, it's clearly a concern of what we've seen. And if we see much larger breakdowns of January lows, then you can certainly say that, the intermediate term trend has started to shift from being really more neutral over the last couple of years to a lot more bearish.
That would be a massive distribution top if we break down,
Right.
wouldn't it?
Yeah.
I mean,
No,
it's
certainly.
huge distribution. So,
But I agree with you with regards to yields trying to bottom out in the next couple of weeks, and so we'll see what shape that comes in terms of how that shakes out.
okay, so the flip side of a weak dollar, and gold didn't need a weak dollar to do what it did. So gold has really been strong, and silver has been really showing a lot of relative weakness. Didn't even make a new high on the last
Yeah.
high in gold. Where are you at on gold? A new high coming, and aren't we getting kind of late in the game for people to start turning real bullish gold, even if we
Yeah,
trade
I agree
1700?
with that. I agree with that only because of wave structure. I mean, I think that many people have remarked that it looks like a pretty clear 5-wave move now to the upside from 2018. Positioning is certainly very, very bullish. It seems like everybody in the world is long the metals and thinks now the economy is weakening and it's right to be in the metals. And I,
Except the
trend perspective,
commercials.
yeah, I think that we're seeing now some signs that this looks only like a 3-wave move. So yeah, maybe you can make a brief new high in gold, but I do think it's late in the game, and one would want to really sell into that. And specifically for the reasons of sentiment being too optimistic and the positioning too high, along with the fact that silver and gold stocks really have not followed suit on the metals. And so that usually is a warning sign that that's very late in the game.
Any view on energy, on the energy sector? Do you think any signs that we're starting to get close to some type of low or base building beginning in oil related issues?
Yeah, it's tough to say that with regards to crude specifically.
Yeah.
The charts there still look very, very negative.
Yeah.
It's we'll see. I mean, we'll see if this is at least structurally, you'd really need to get up over close to $50 before you think that WTI can start to move up. And the energy sector itself is already down over 25% in 2 months. I mean, it's been a real washout. And so, if you look at it, I actually got long some Exxon the other day only for a trade, and thinking that these have started to stabilize in the short run and can make a little bit of a bounce in the days ahead. So I see it as a good risk reward to play it for a trade, but really anything longer, I just I don't really see it. I look at this chart. Here's a monthly chart of the XLE and how that looks, and that's just really awful. So on any bounce above really to the mid 50s, I would certainly look to lighten up in terms of XLE, and we'll see. It needs to do a lot to really recoup some of the damage that's been done. It's been catastrophic. So if the demand slows down materially based on the corona, and I actually have I have a couple contacts that suggest that the things are going to get a lot worse, that the numbers have been very much understated, particularly all along the West Coast, and that it's just a matter of time. And so it's we'll see. Not to scare anybody, but it's certainly not something that's just going to go away right away, even though it might be mild in terms of how to treat it and prevent it, and it's not really a true threat, but it's certainly on its way.
Not this time around. Yeah. Let me ask you this, Mark, since you brought it up. In the pandemic, Spanish flu wasn't the first wave that was really catastrophic. The first flu season, it was when it returned the second time. Are your sources saying that this is just going to become part of kind of a virus life cycle, and it can be around for a few years?
I don't know about that. I don't have that kind of information or data.
Okay.
I just know that the next 4 to 6 weeks, which lines up with a lot of cycles, that things are going to get a lot worse. And if people are canceling trips now because of what they think. I mean, in the next month, it's going to be really center stage. And so, for me, that lines up with a lot of things that suggest that, equities at really any balance you really want to be probably selling into for now.
Okay.
I think that, whether it was a first, 5-wave move to the downside, now we're getting a wave 2 or wave B that we should have at least a C, or the start of wave 3 to the downside now that could last between April and July, August. So,
Okay.
there's an 18-year cycle. It's actually 18.6 for those that are familiar with that. So,
What's the name of it?
So if you look, what happened, SARS was this time 18.6 years ago. And before that was AIDS and HIV, the HIV and AIDS was prior to that. So we have a pretty, my colleague and friend, Andy Pancioli, who's a cycle expert.
I know who he is. Yeah.
Yeah. So he's a good guy. He's written pretty extensively about it. And so, he turned me on to that, and also the fact that there's also a 100-year cycle also that's related to a lot of this. So 2018.
That was the Spanish flu.
Yep, 1918, 1818, 1718, 1618, all along the years. So there's
ask Andy that if the first wave of the Spanish flu wasn't as bad as the second season. So Mark, I mean, are you doing anything personally, you and your family, storing up food? Do you think we're going to have some type of medical lockdown in different areas?
No,
I'm
not. I don't. You know what? I mean, I think the best you can do is just stock up on some extra bottles of NyQuil and DayQuil. I think that's probably the best for long type issues. But
how about supply chain issues? Where there might be shortages of things. Do you think that could happen?
The one thing that I've learned that I think I can pass on is that hand sanitizer is probably one of the worst things that you can put on, because it literally eats away your hands, and it will actually expose you to the virus quicker than if you just use
soap,
some type of the wet wipes, or the things that are hand sanitizer. The actual wipes that you can use are much more effective than hand sanitizer. And so the masks also, as we've heard, aren't really all that effective, and actually can be eroded within 4 or 5 hours of breathing into them. And so it's really useless to wear something of that sort unless you're going to change it very often. It's more about us not touching our own faces, as we know, and trying not to shake hands, and just giving fist bumps and elbow bumps and things of that sort. So.
Okay, well, let me give you an internet hug for coming on and clarifying a lot of things for the community, and edifying face for us, Mark, like you do so many times. And hope you and your family are safe, and that we catch this failing rally the right day, the right hour, the right 15-minute time frame to ride it down.
I'm looking at early next week, actually, right around the 8th. The 8th will be on a weekend, so 9th and 10th into the Fed is being important, and then on the 20th, 21st in the equinox, there's a lot going on there, and then of course in early April also. So we're certainly entering a time which could be high volatility. The momentum on a weekly basis clearly has broken down, and we saw a couple of years ago when markets peaked in January 18, the momentum reached its highest levels that we'd seen in some time, and then the market went higher and higher, and momentum just really failed to keep up, and that was really a warning sign. And so, now on a weekly basis, with this having rolled over, I'm expecting that we do at some point get down and test this area near 2,500, 2,600 area, which is going to be pretty important. And
some wave guys are looking for us to go to test wave 4. Where's that? Around 2,400. That's at low in what, 2018? There, is that it?
Yeah, 2346.
Yeah.
Okay. We'll see how it shakes out. The one thing I would say is, although I do like using logarithmic charts, if you use an arithmetic, just pinpointing the bottom of 09, you've actually hit this on 3 separate occasions right to the nose. So, that's going to hit right down near 2,500 on a pullback. So I do think that does have some importance. The final thing I'll leave you with is that it's always important to watch the 10-month moving average when markets close under that. Historically, when markets break trends and turn down, if you would have been out of the market when we closed under the 10-month, you would have literally been out of the market during the whole bear markets of 2000 and 2003, as well as 07 to 09. So we're actually back up above it right now, but if we
where's it
close
coming
down
in?
under that again, say that again.
Where's it coming in? Around 30.54?
Yes, that's right.
Okay.
So just say if we fail and pull back under new lows, then you really want to be out of the market, and just wait until that shakes out a little bit. But yeah, right now I think there is a lot of fear, and so that's the one arrow in the quiver for the bulls, and we have gotten pretty washed out and oversold near term. So you need to consolidate the oversold conditions, which has been happening in the last week. And so if we rally into the next couple weeks, I would look to sell into that. We'll just leave it there.
Okay, well, with the calmest demeanor, you're a watchman, talking about something that a lot of people probably aren't aware of, the ostriches with their head in the sand. And really, thank you, Mark. Thank you for being
my pleasure.
here today.
Thanks for having me on, Dale. It's great to talk to everybody.
If you want to just show your website, Mark, because I think everyone should use you as a resource for what's going on, because you put it all together, the fundies, the technicals, the cycles. You really have a great holistic view of looking at the market. So there's
Mark. So I came from the CBOE. I used to trade as a market maker on the floor. I worked as a technical analyst at Morgan Stanley for a few years back in the 2004 to 2007, and I joined Diamondback, hedge fund. A lot of ex-SAC guys started out, and then I actually ran my own. I started my own website 3 years ago to offer technical analysis to institutions and to individuals. So feel free to come and visit. I am going to be on CNBC actually today at around 2:20 to 2:25, and potentially Fast Money if that's tentative at this point. But yeah, I am going to be on later. So send me an email to info@newtonadvisor.com. I'm happy to put you on a trial or show you some copies and samples of my work or what I've been putting out, and we'll take it from there.
All right. Well, good hunting, my trading warrior brother.
Thanks, Dale. Take care.
All right,
we'll talk to everybody soon.
All right. Thanks, everyone. That's Mark Newton, and you can follow him on Twitter at Mark Newton CMT, and go to his website and stay in touch with a guy who's a great technician and has a very good feel for cycles and everything that you need to be alert to what's happening in the market. So that's a wrap. Thanks again, Mark. Everyone, remember, don't just count your pips, count your blessings. Stay safe and healthy, and we'll see everyone tomorrow for the NFP. Be here live for it. Adios. Thanks, Mark.